Hey guys, so today I'm gonna show you how to solve this type of problem, which you will most likely get on the exam. Now, this problem can have four types of questions. I'm gonna solve it all, and then for each type of question, I'm gonna show you the answer. So, beginning January end this year, company Jacob collects a loan of 40,000 euros from a bank. Loan of 40,000 euros. The interest rate is 4%. At the end of the year end, Jacob reimburses 20% of the loan and pays the annual interest. So, reimbursed 20%. 20% of the loan will be reimbursed at the end of each of the following years. The net impact, positive or negative, on the income statement of this loan in year end is. So, reimbursements, you pay 20% each year for 5 years until the whole loan is paid back. So, 20% out of 40,000 is gonna be 8,000 euros. This means these 40,000 euros that you loaned from the bank during 5 years, you pay back each year 8,000 euros. Until after 5 years, you've paid the whole loan back. The interest, because the bank wouldn't loan you money if they wouldn't win something, they wouldn't make a profit out of you. You're gonna pay interest. So each year you pay what's left. Each year you pay the first reimbursement of the year plus the interest for each year. So let's see what happens during year end. In year end, the first thing that you do is you add money to your cash account. So you borrow money from the bank, which means your cash increases because now you have more money due to your loan. So you debit. Debit means money goes in. Credit means money goes out of your account. So you debit cash, 40,000 euros, current assets plus. So the current assets, the cash in your current assets increase. Second, you credit long-term debt, 40,000 euros, non-current liability goes up. You credit long-term debt because now because you borrow the money, now you owe the money, so you'll have to pay the money back, which means you have to take them out of your account, you have to credit them. Non-current liability plus, the liabilities part of your cash account, your liabilities part increases because now you have more money that you have to pay back. So if you wouldn't have a loan, you have zero money to pay back. Now, because you borrowed something, these increase what you have to give back. So that's why non-current liability goes up. Now we're done with what happens to the loan. We'll see what happens with the reimbursements. So in year end, this year, first year, you pay back the first reimbursement, so the first 20% out of 40,000. So because you pay the 20%, you credit cash, 8,000 euros. Current assets go down because you pay out of your cash, so obviously your current asset account goes down. 4, you debit long-term debt, 8,000 as well, non-current liability minus. You debit the long-term debt, 8,000, you add money that you already paid in your debt, so now you don't have to pay back 40,000 anymore, you pay back 32,000 next year. So the non-current liabilities go down because now instead of increasing your cash that you have to pay, because you paid a part of it, you decrease. So you decrease what you still have to pay. And 5, we find out what happens with the interest. We credit the cash 4% out of 40,000, which equals 1,600 euros. Current assets go down and equity goes down. Equity goes down because the interest you pay is from your own money. Equity means is what the company has, the money the company already has before all the loan happened. So these 4 steps are just about the money from the loan. And the last step, affects your own money, the money you had before the loan. That's why the equity is affected as well. Now, in the next year, in year N+1, first thing that happens is you pay back the reimbursement for that year. So in this year, in year 2, you pay back the reimbursement, and again you will pay back the interest. There is no loan in year 2. There is no part of the loan in year 2 because you only borrowed the loan in year N. In year 2, you just pay back what you have to make up for the loan. So first thing, you credit the reimbursement, credit cash 8,000 euros, current assets go down. Second, you debit the long-term debt 8,000 euros, non-current liabilities go down. And third, you credit cash 4% out of what's left from the loan after the first year reimbursement was paid. So it's 4% out of 32,000, 1,280 euros. Current assets go down, equity goes down as well again. So if you would have been asked in year N+2, the credit on cash part would be 4% out of 32,000 minus 8,000, the reimbursement paid in the previous year. So just remember that for the interest part, you only take the interest out of what's left from the loan. So now for the questions. First question that you can have is the net impact on income statement. The net impact on income statement in year N is just this. So you don't have to do all of it. You just find out the interest part. Net impact on income statement. As well as 1,280 is the net income. This one is in year N. The net income in year N+1 impact. Okay, now the second type of question you can have is the impact on cash. Impact on cash in year N. In year N will be, here we just look what affected cash. So the 40,000 that was added to the cash, the loan, the 80,000, that's the first reimbursement, and the interest that you paid. So the impact on cash on year N is plus 40,000 because there's a plus. Here for the reimbursement would be minus because you paid, as well as for the interest because you also paid. You don't add it to your cash account. Minus 8,000, minus 1,600. So the impact on cash in year N will be 30,400. Now in year N+1, the impact on cash. We'll look again just at the cash. And now there's no loan, so it's just what you pay back from it. So it's minus 8,000 the reimbursement, minus 1,280, which is minus 9,280 euros. So yeah, this is it. This is how you solve this type of problem. You can only have 4 questions for it. And yeah, this is a big part of your exam. So make sure you understand it all. If not, just DM me. I'm here to help. Thank you guys for watching and see you in the next video.